Hello, everyone. Mike Arnold here, co-founder, Pat Trading Partners, along with Bob Iacchino. How's everyone doing this afternoon? Everything going well? I hope. Another back and forth day, breakdown and bounce back. Lululemon, beat, big gap up. Micron was a miss. So that sums it up. We're all done. Everybody have a good evening. Hello, Patrick. Good afternoon, Jacob. Very quiet today. Wow. All right. What else do we have? What else did we have today? Let's take a look. We had consumer confidence bouncing higher than previous and much higher than forecast. Richmond, Fed, manufacturing and services both in contraction, and services a huge miss. Down big from prior, and it forecast was 3 and coming in minus 17. Dallas Fed Services forecast minus 21, coming in minus 18, which is still bad, way down from prior. Not good numbers out of the regional Fed indices. Good evening, Anissa. Tomorrow, we got MB mortgage stuff well before the open, 2.5 hours before the open. Then after the open, 30 minutes after, we have pending home sales. We have bar testimony continuing. We have the EIA crude numbers, and that's about it. Not really much on the table tomorrow. Not much. Today, energy leading the charge, and mega caps pulling back. The heavy lifting this afternoon was not done by mega caps. Healthcare was very mixed today. Basic materials doing pretty well. You can see here energy and basic materials and consumer cyclical leading it higher. Com services continuing to pull back. Com services continuing to pull back. Fed watch 58 to 41. 58 still favors the pause. Fear and greed still in the upper end of fear mode, but not in neutral yet. As I said, Lululemon was a beat. Micron was a miss, but didn't really move off of that unless it's moved since I looked last time. Did not look at Dave and Buster's. Tomorrow morning, there's really nothing that's going to be market moving before the open. After the closes, Restoration Hardware is about the only thing I'll be looking at. So, hey, Daniel. All right, so thought we were going to get the breakdown with follow through, but no. Broke down, and then snapback. The old snapback. Coming into, you see here, 50 to 62.5, which is always key to watch. That's from the most recent high to low range. And snapback in the afternoon, after lunch snapback rally. Where does that put us? Still, a whole lot of nowhere. That's it, whole lot of nowhere. Unless we really start breaking below today's low or breaking above today's high, those are my support resistance for the end of the overnight session. If we do break above today's high, I'm focusing on yesterday's high. And that's about it. There's not much to talk about. NASDAQ breaking down briefly below key support into the rotation zone and rotation back up. Right now it looks like it's going to close above the rotation zone. Same little thing. Little bounce back here. Little bounce back here, just going into the end of the day. Really sloppy there. So unless we take out this afternoon's low, but then they're slamming down into about 12,570. So there's just not a lot of great short opportunities just yet. Not interested in any real longs until above the high. So those are the two levels I'm still watching. Now, if we start breaking down European session, 12.7. 12.7 in European session, then I'll take some notice. We'll bring on Bob in 1 second. Dow caught between the two critical levels, 32.5. 32.8. So it's either to break down below 32.5, break out above 32.8. Otherwise, nothing to talk about. And Russell, very narrow. I'm just watching this two top area about 1779 for a breakout, but then it's going into major resistance area. Breakdown, nothing to unless below today's low. There's your Russell. Nothing much. Again, not a whole lot of anything. Let me just bring on Bob. Hey, Bob. Wow.
What's up, Mickey?
Wow. Hold on.
What the
You
hell is
know,
that?
when it randomly switches my displays, oh boy, there we go. And I even have it locked. And then I get a random display switch. What? All right. Now you're
Weird.
back. Now you're
Oh
back.
my!
So what's going on, Bob?
I'll throw you a little something. Can you put up a 10-year note chart, either yield or price? I don't
Which
care.
would you
And
prefer? We got
also,
both of them.
let's do yield. And
There you go.
also,
Micro yield. Climbing towards the double
I
bottom.
emailed you something.
And an email on top of it? Wow.
Top of it.
Wow.
The
Heck, there we go.
gold
All right. I
oil
got your
gold
email.
ratio. All right, the oil gold ratio, if you can put that up, has been remarkably not only consistently correlated with the 10-year, but it's also been a predictor to a certain degree. Not exactly. Correlation's been somewhere around 78. All right. So correlated about 78% of the time. For those of you that aren't following any correlation theory at all, um, it's starting to the oil gold ratio is starting to collapse. So what does that mean? Well, it means the amount. Let's just call it the amount of an ounce of gold it would take to buy a barrel of oil. Right now, it's right around 38 or so. So 38%. Right. So it's yeah. So that's where it is around. Not 38%, 3%. Sorry, I screw that up all the time with the when it's shown in decimals down there. So it's close to 4% basically. So 4% of around 19,000. Where was gold today? About 1977 or so. I'm trying to
Gold
find it over
finished
here.
at
Yeah, 1975.
1975.
So approximately 4% of that's about 79. So it's a little bit low below that with crude oil at about 76 or 77. What was crude oil today? 73. So about 3.8%, maybe 3.6%, somewhere in that range. So as you see this start to fall, you can assume that there's lower 10-year treasury yields coming at
Okay.
some point in the future. And it's kind of led. So if that were the case, one of the things that I really don't like is they're starting to take away the rate cuts little by little in the Fed Watch tool. If you've watched that probabilities tab,
Well, let's get there right now. Hold
so
on. Hold on.
pull that up too. This is
Let's.
all leading somewhere.
Well,
You go to that probabilities tab, and if you guys remember, there was a pretty solid step down of rates. And now they've got it holding steady for 3 months, then holding steady for another 2 months after one cut, then another cut, then holding steady for another 2 months. So that aggressive every single month cut has been slowly taken out of the market. BlackRock yesterday put out a piece that basically said that the market has it wrong. There's not going to be any cuts in 2023. And we all know BlackRock controls the entire world. So if BlackRock is saying it, they're probably talking their book. And if they're talking their book, they're probably commanding their book to the rest of the federal government. So I'm obviously kidding there. But if the oil gold ratio is right, it would make sense to me because if the Fed holds rates here, they're going to slow the economy into a recession, and that will likely cause a drop in yields because that's the only thing that's going to slow inflation to the level where the Fed would like to see it, where they can then potentially start cutting rates. So I was really, it was interesting to me when I saw that gold silver ratio from Invictus when they pointed that out. That's Invictus research, by the way. Pretty pricey service, but we're going to have Mike Singleton, who does Invictus research on the podcast. And actually, Mike, he's going to be the second half of your show coming up.
Okay.
So we're going to do the first like 35, 40 minutes with Mike, and then Mike will join us. Hopefully, Mike, you'll stay on, right?
Yep.
To talk to Mike Singleton. And this is the kind of research he puts out. So I thought it was really, really interesting to see this predicting lower 10-year yields. So lower 10-year yields, potentially a much, much slower economy than we're seeing right now. And I would push that into lower stock prices as well. You can't look at today as any sort of signal in stocks at all to me. I mean, I think you kind of said that when you were saying a big nothing burger today on all the charts. It's just kind of trending in there,
Yeah.
or just kind of nothing at all happening. It's just quiet.
We're going
And
into
then the
month end.
last thing,
We're going into month end, and we've gotten a whole lot of nowhere. Really, as
yeah,
you say, candlestick math. We've gotten a whole bunch of nowhere.
whole bunch of nowhere. And then if you look at crude oil has kind of made its way back up into that channel that it had been in. You know, Bra had been asking what the hell's wrong with crude oil, and basically nothing. And crude oil is doing what it's supposed to do. So we're kind of at that big resistance point, almost back into that sideways price movement. So if it fails from here, it's much lower prices. If it goes back into the channel, then it goes back into the channel. I would even say that it'll be a downward sloping channel at that point, that we might see lower highs, but still more sideways stuff out of crude oil. And that is also implying a slower economy, which would also imply poorer earnings and a slower stock market, a lower stock market. But I still maintain that if we get a break of those October lows, we're going to be looking at a 1 or 2 year bottoming pattern that'll come in after we break those October lows, which I still think we'll do. So that's really all I'm looking at. I mean, there just wasn't much to talk about or look at today. So
There's been not much. I mean, the last few days, there's been not much. I mean, we had some
yeah, so nothing
volatility,
to
but
talk
there's again, it's a whole bunch of nowhere. And their trade
about.
setups are abysmal right now. I mean, it's like this is a perfect time to take a vacation.
Yeah, totally agree.
Well, I guess
Totally
a lot
agree.
of people around here are on spring break around here, so they are on vacation. So you think the notes are going, the yield's going to roll? I mean, there's no time. That was a leading indicator with the chart you sent, but there's
Yeah,
no exact. Again, timing's the brutal thing in all this.
timing's the brutal thing in all this. So, like, I could totally see that double bottom triggering, and yields going higher. I could see that happening. Then I could see a rotation down from there, and it would not be disagreeing with the leading indicator, which is the uh, crude oil ratio. I'm sorry, the crude oil to gold ratio. It wouldn't disprove that indicator at all. It would just be showing a little bit of more lead time in the indicator over the 10-year. So not something you trade. You don't look at that and go, okay, it's starting to turn down. I got to short 10-year treasuries, right? Or I got to go long 10-year treasuries and short yields right now, or other way around. I'm sorry. My brain is fried. It wouldn't be an indicator to immediately take a long position in notes on the future side, short position in yields. It wouldn't be that at all. So just something to look at from a more general macro perspective. Filling up my water bottle because
I
my
can.
brain is dried out.
It was either one of two things. It was filling your water bottle or, uh,
The other thing I need to do in the bathroom, not here.
yeah. That's why.
I,
That's why I went with the water bottle.
I try to drink one of these a day, but again, other days I'd rather sleep, so I don't drink one of them. So anyway,
Bra wants to know, hey Bob, is it time to buy natural gas? The downside is overdone.
no, I don't buy bottoms, bro. I don't like try to find the bottom and buy it. We need to have a pattern that pushes us in a positive direction. I don't say this is overdone. I'm going to buy it here because overdone can get a lot more overdone. So for me, no. If you're a bottom picker, it wouldn't be a horrible place to do it, but that's not what we do.
but I don't even have a. Again, I've had this. People ask me this for about a week now, and they're like, "I'm gonna buy it. I'm gonna buy it. I'm gonna buy it," and that was starting at 220, and now it's at $2. That's why I'll wait for a pattern. Personally, there
Yeah.
isn't even a short term bottoming pattern. Doesn't mean it can't snap back rally, but it's going slamming straight into rotation zone on the daily. I mean, it's scalpy to the upside, and this is even seasonality is not strong for natural gas right now.
No, seasonality is not strong at all. So it's just it's a bad actually it's a bad commodity to try and pick a bottom into because there's just so many political factors in it as well.
Yep.
Like, the price can just completely collapse if the weather turns warm and the Ukraine Russia war ends with a treaty on natural gas. All of a sudden, the bottom's going to fall out again. So there's just a lot going on with it.
Where do we sit with the longer term? I mean, the longer term, you got your major support back at about one. Where's that? 145 to 150, and we're at $2 now. I mean, we're heading into a major support zone, but that doesn't mean you just buy it. So, uh, what else? Any more thoughts on gold? We've come back down to. We haven't triggered the double top yet. We've come back to rotation zone, rotating back up with an inside day today. Anything on gold, Bob?
No, I still really like this position from a fundamental standpoint. I mean, fundamentally, to me, there's three possible outcomes: a soft landing, or gold goes higher on a recession because the Fed is poised to cut even if they don't, or inflation continues to rise, which the inflation strengthening asset prices pushes gold higher. So, yeah, I don't. I like this position a lot.
Dr.
So there's a
Michael.
George Gannon question. Yeah, go ahead,
Yeah.
Mike.
George Gammon predicts a crash soon. Your thoughts are greatly appreciated.
So I think I mean, it's an easy prediction to make right now, Dr. Michael. The thing Mike said earlier, the timing on these things is the problem. And somebody actually asked me about George. I don't know if it was here or somewhere else. And I remember going to his YouTube. I don't watch his YouTube stuff, but I remember going to his YouTube channel and noticing that every other video is the crash has started. Here comes the crash. Time to panic. Every single one of his headlines. Now maybe there's more in the context of the videos. Again, I don't watch him. I don't want to disparage the guy because I don't watch him. But the timing's the problem. Actually, let me pull up his page. See if I can do this really quick. George Cannon, YouTube. There he is. Okay, videos. Sort by date. Okay. All right. We're going to crush the economy 3 months ago. It's time for some pain 1 month ago. The experts are terrified 4 months ago. We're on the brink of disaster 5 months ago. It's time to panic 6 months ago. The crash has started 5 months ago. Um, I guess you could line them up with what Mike and I have been saying that the October lows are not the low. We've been saying that for at least, I don't know, what would it be, Mike? Almost 6 months now. November, December, January, February, March. So 5 months ago. So I just think, again, you're talking about timing on this stuff. And I would put myself in the same batch where I've said end of the first quarter, beginning of the second quarter for the lows to not hold. So I'm not necessarily comparing myself to him. I'm just saying that I don't watch his content. So if he gives you timing on that, I'd like to know about it, but I don't watch his content. So I would just say, be careful about clickbait headlines like that because you might watch a video where it says a crash is coming and then you watch it and it'll say sometime in the next 10 years a crash is coming. So I don't really know. But I don't think a crash is coming necessarily because I've said this before, a crash is like pornography. You only know it when you see it. it's difficult to describe, but you recognize it when you see it. I would say it's a multi-percentage move that sustains over a couple of weeks and with high volume and a lot of news coverage. That's kind of how I would define a crash. Um, 2000 in the NASDAQ was definitely a crash, 70 some odd percent lower. I think it was 78% lower when it was all said and done. So just difficult to analyze his content without watching, but he's been calling for a crash for a long time. Mike and I don't use that language. It's hyperbole, really. Um, and, again, even if we did, if we said, okay, by the way, guys, this past week, let's say there was a big move down and all of a sudden we're like, this past week was a crash, guys, just so you know. How did that help you? Like, how did it help you by us? Oh, you can officially call this a crash, right? Bear market's a bear market, bull market's a bull market. So again, I'm not trying to disparage the guy. I don't watch his content, so I'm not saying anything bad about him at all.
What else do we have? Bob, any thoughts on a credit crunch happening in the second half of the year due to refocus on banking and drop in liquidity?
Well, I wouldn't say regional banks would drive a credit crisis. I would say they'd be a big part in drying up regional lending. So all that really points to me is a lending slowdown. And the big banks won't make that up because they don't work that way. They do much larger loans. I mean, yeah, you can get a home loan at Bank of America, but regional banks are more about the car business, the homeowners business, and credit crisis would probably include credit cards on there. I'd keep an eye on it, but I wouldn't say that it's going to be triggered by regional bank issues. And again, those regional banks, it's funny, we're so focused on the liquidity from the outflow of deposits that happened that has now seemed to have been stemmed, but no one's talking about potential bad loans on their books. So that would be what I would focus on. So I would say that there might be a rash of bad loans in some of these same regional banks that could trigger a second run once the news gets out, but we'll see. I don't have any inside information on that. So I wouldn't say the regional banks would cause a credit crisis.
And good afternoon, George. Pep wants to
So
know why the market's still holding.
I mean, I don't really think it is, but whatever. You're looking for a crash, and that's you didn't get your crash. Is that what it is? There's just no news, dude. I mean,
There's nothing. We're
there's nothing
winding up
going
one
on.
earnings season. We're going into another earnings season where, it's end of quarter right now. There's actually, boy, there's not much impetus. I mean, it'll get interesting on Friday, maybe with PCE numbers, but that's one. We don't have anything unraveling. There's no big news cycle going on with anything. It's just sort of might be the calm before a storm,
Yeah,
but
could be.
who knows? I mean, that's where I gotta wait. Once we get key closes below key levels or key closes above key levels, then we'll have something. Right now, it's just caught in a big bunch of gunk of nowhere.
Yeah.
Sterling, in the car business, I see trouble ahead in the credit markets. Consumers' overuse of credit cards have caused their scores to drop, and the banks are starting to want better quality borrowers. The current situation may end up being worse for those of us rely on credit for business than in 2008 due to the fact that we did not have these sticky inflationary pressures then.
It could be. I mean, the car business is an interesting canary in the coal mine, and it always has been. Again, and we talked about this before, Sterling, so I really appreciate your comments. Um, During the last crisis, 2008, 2009, people were actually defaulting on their mortgages, but still making their car payments. And yeah, there was a lot of repossession of cars, but nowhere near relative. There were people who were losing their homes that were still keeping up with their car payments. They would just not pay the mortgage. And probably, rightfully so, because it's easier to repossess a car, especially with navigation, than it is to foreclose on a home and kick somebody out. It takes a lot more to do that. Banks are less motivated to do that than auto loan companies are to repo. So I think that was pretty interesting. But anyway, yeah. And Sterling, actually reach out to me privately when you have a second. I gotta ask you something. So
Hey Bob, Lulu was a huge beat, and oh boy, look at this! It's up over 10% after hours. Any thoughts on the high end consumer who buys the what do you call this athletic wear?
athleisure.
Athleisure is has not tapped out.
Yeah. So Lulu specifically, I actually kind of don't like this stock in general because they're a luxury item and it's what we call a hard loss item. It's what I call a hard loss item. People who are fans of Lulu, and because my sister's one of them, they can't part with their Lulu. It's one of those things. It's one of the last things they cut. Like they cut food before they cut their Lulu out. So I suspect that'll change in the next economic downturn. If we go into a recession and we start to see massive job losses, 6, 7% unemployment potentially, I think Lulu suffers quite a bit, but it hasn't hit yet. So
Yeah, it's definitely hasn't hit based off these results. I mean, they blew it out with reported. I mean, big. I didn't dive into the earnings yet at all to make sure they're not the low. You know, some of these beats you really look at them, you're going, oh, well there were
yeah,
five one offs in there. I
yeah,
mean, boy, and before it was priced at 34.88 PE, and now it's up from there. It'll get interesting on some rollover, but it's not there yet. Sterling says,
right.
will do, Bob. Santer says, Bob, I see a correlation between gold and stock market. Gold looks strong. That means stock market will go much lower? Question.
Well, you're saying you see an inverse correlation then, right? Not a correlation. Gold. All right, let me see. The last 180 days, gold has a positive 58 correlation to the Dow, okay, and a positive 26, which means a negative 74 to the Nasdaq. Okay, so the correlations are not. You may or you may not be seeing what you think you're seeing. Okay, again, that's the last 180 days. Now, if you're seeing something, let me look at 30-day. I'll take a look at 30-day and see what you're seeing. Because if you're seeing a 30-day correlation, yeah, you're seeing a 30-day correlation. So to the Dow, negative 59, then negative 40 to the S&P, 61 to the NASDAQ, negative 84 to the Russell. Okay, but that's a 30-day correlation. So I wouldn't trade off that personally. Okay, the longer term correlations between gold and equity markets have quite a bit to do with other factors, right? You want to look more at gold and yields and gold in the US dollar. So I'll explain what I mean by that. Gold is a risk asset in that it's a flight to safety asset. It's a store of value. Okay. If things are going to shit, people want to buy gold because they know they can hold their bars of gold and no one can take them from them, right? They're not going to lose their gold deposit in their desk drawer, right? So when yields go up, treasury yields are the next best thing in terms of safety, US treasuries. So if you buy a 6-month treasury or a 2-year bill or 2-year note rather, your money is as safe as it is in gold theoretically. Okay, it's considered the risk-free asset, treasuries. So if treasury yields are higher, people are more inclined to go into treasuries than they are into gold. If yields are lower, people are more inclined to go into gold because they're not worried about losing that yield because it's not much of a yield anyway, right? So if treasuries go lower, what happens to the stock market lately? Lately, okay, it goes up. So does gold, okay, because yields are lower, so gold is more attractive in terms of a flight to safety. So it's not the stock gold correlation you're seeing. It's the relationship between stocks and yield and gold and yield, meaning over here. Now, those relationships change. Okay. Sometimes the stock market goes up when yields go up and vice versa. because if all of a sudden everything is getting positive and there's a potential for inflation, yields may go higher while stocks are going higher and gold's going higher. So I wouldn't rely on that correlation you're seeing, especially if you're talking about 30 days worth of it, because it's not very reliable at all.
Feedback wants to know what's the best data source for tracking household savings rates.
The Fed website, St. Louis Fed, you can look at consumer the household savings rate at Fred, which is the St. Louis Fed website.
So there you go. All right. Well, that looks like
Yeah.
about it. Again, there's just not much going on. So I'm not going to force a longer live stream that needs to be.
No,
Let's
that's it.
just thanks for coming on, Bob.
Oh, you're welcome,
And,
dude.
and can will you be back on Thursday or?
Yeah, I'll be. I should be. I mean, so far I should be. And last thing, Dr. Michael says huge premiums over spot for many U.S. gold coins. Be careful. There's always a premium. You're better off buying bars than coins. Okay, Dr. Michael.
Also,
You're much
Rich just
better
wants
off.
to know real quick. PCE. Will the PCE numbers be important? How will they affect the market? Then we're done.
Yes, it will be important. By the way, PCE is also how the government measures inflation for the purposes of certain programs they put out, not CPI. Okay, so PCE is very important for a number of reasons. It's also what the Fed looks at. So PCE is a good 2 percentage points lower, I should say, two numbers lower, oftentimes than CPI is. So if PCE gets to 3% and CPI is still at 5%, the Fed's only 1% away from its target because it looks at PCE, not CPI. So we should be talking about that a lot more. We should be talking about PCE in the public sphere more than we do CPI.
All right. Thanks, Bob. You have a great
All
rest
right,
of your.
guys.
All right. Bye.
See you later.
Okay, everyone. Let's see. I already went through a bunch of these things. VIX, again, dumping way back down into the low volatility. No fear in the market. DAX, not much to talk about. Same massively choppy setup. Notes, still not close to trigger. Why do I have run seen on here? Fantastic. There we go. Notes, still in the rotation zone. Interesting enough, if this does trigger in the next few days, the rotation zone and the 50 might be out of the way. Other than that, there is nothing long term. We glanced at the yields. We have the potential double bottoms. Yield curve. Yield curve still pulling back in the rotation zone. Only going to really sit up and take notice if it drops below about minus 57. Dollar index pulling back below the 62.5 on the close, so I'm expecting a further pullback on this. Cycles are edging back up to the top too. Crude we already looked at against some key. Cycles are at the top, so it's at this point, personally wouldn't be rushing into anything, would be watching for some kind of pullback play and how that pullback looks. What else do we have? Euro, Japanese yen. Again, not much unless we really, if we break above about 131.60, we'll watch for a short-term little possible rally to about 132.50. But there's no great bottoming pattern yet. Euro, again, stalling out right at the 62.5. So again, everything sit on the friggin' hands. Pound, not yet hit the 87.5. Bitcoin still holding the key support. Tesla, a little pullback with some other mega caps. Confirming but not triggering the double. Again, we're still dip, boom, bye. So, sorry, there's just nothing for all you NVIDIA watchers. Down slightly, maybe in sympathy with Micron. Let's take a quick look at Micron, but bouncing off the key support level. What would be interesting is if this does get a bottom and falls through above today's high, it's an aggressive percent. Well, it's a percent beat buy with the rotation zone. It's aggressive because of how overextended we are, but it is something that we could retest the topping areas. With Micron, Micron's up. Micron is a miss, and it's up. So that's all you need to know, but it's still overall in a choppy mess. Other than that, inverse head and shoulders, Intel. Inverse head and shoulders. No. If you're looking for anything, it would just be at this point a massive horizontal channel breakout to the upside. But it would really have to be getting above about 3150 on a closing basis. Other than that, it's just in a big horizontal channel. So unless you're trading support resistance, and by the way, it's at the weekly cycle top, so I'd be more watching for a potential pullback than a breakout at this point. So that's really about it. Not going to keep anybody any longer. We'll just see if anything's setting up for tomorrow. Until then, I will be back tomorrow at 8 a.m. Talk to you all later. Bye for now.